Well, hello and welcome to Finding Alpha. I'm Nigel D'Souza in the Mumbai News Center. It's been a challenging year for Indian equities. We have seen sustained FI selling, renewed tariff tensions under President Trump, geopolitical concerns, and muted earnings. All of this has put pressure on the Indian markets. But there's a growing sense of optimism that things could actually be turning around. Well, on this special edition of Finding Alpha, we're joined by Amit Jeswani, founder and chief investment officer at Stallion Asset company. Well, Amit, thanks a lot for joining in. And before I start off the show, it's going to be a very, very special Diwali for you, because in the last 45 days or so, you've welcomed a baby girl. So all the best to you, your family, and congratulations on the little angel.
Thank you so much, Nigel. It really means a lot.
Okay. All right, Amit, let's get to discussing some themes then. Walk us through the key playbook as well as strategies investors should keep in mind when they navigate the Indian markets from here on. You know, if you could help us out with a few of them. So my first question to you basically is, since we're going to be talking about playbooks, strategies as well, earlier, if I recall, a couple of years or so ago, you all were, more towards small cap companies. But if I look at your portfolio right now, it appears you're tilting more in terms of the large cap. Tell us how you're constructing it.
So we've been 50% large cap for the last 7 years, broadly 48, 49% large cap for the last 7 years since the inception of Stallion. We've been about 22 mid cap and 18 small cap, 10% cash. If you take 7 years of average of Stallion Asset as a fund, we've always had near 50% exposure to large cap. It's just that when there is risk on, we go towards high growth small caps as well. And when we go to small caps, our expectation is, so we don't go for small caps, which typically grow at 20%.
Okay.
We want small caps, which can grow at 40, 50, 60%. See, the idea is to make, in a bull market, the idea is to make as much money as possible. In the bear market, you want to retain whatever you made in the bull market. So in bear markets, typically, so in 2018, 2019, the markets were all about quality. We were with quality.
Right.
In 2021, when we keep moving where the markets are moving.
Right.
But over time, we've understood that there are those super cycles that come about where you can create outlier returns. See, our goal of a portfolio management company like ours is to create alphas for our clients. And alphas need superior returns than benchmarks. So you want to be in companies which are growing way faster, but you also need tailwinds. You cannot have companies that can grow super fast without tailwinds.
Got it. So, Amit. So I think we get that point then on that front, because I think in cricketing parlance, what you're telling me is that when the wicket is a little tricky, you want to hang in there, and face a large number of deliveries, while when you're seeing the ball big, you want to smash it out of the park. So we'll get to a couple of playbooks on that front. But let's talk about a couple of themes first of all. With the various fiscal, monetary policy as well changes that we have seen, discretionary consumption is something that you're a little bit bullish on. So explain that to us.
So we are actually bullish on consumer-facing companies broadly for last 7 years. For us, has been 74, 75% of our portfolio. We do not invest so much in government stocks. We've never been able to create alphas. It's just that our playbook's not strong enough. We invest in processes, and our process is very simple. Right now, about 70% of Nifty companies will grow at less than single digit. Your GST growth is around 8-9% for the first few months of this financial year. If your GST growth itself is 7, 8, 9%, companies which can grow at 25, 30, 40, some food delivery companies would grow way faster than that. So wherever there is growth, and that has always been our style, we chase growth. And wherever there is sustainable, predictable growth, and there is the largest player is gaining market share, that is where you'll find us. And and that's the whole playbook, that there is a super trend right now in internet stocks. Internet is the leader of this bull market. And just find good players out there. And if you get a few themes right, this in bear cycles also you can make money. 1996 to 2000, the markets went nowhere, but your tech stocks went up 100x, 200x, 300x. Even post that. Between 2000 to 2003, or Hero Hondas, etc. The companies who keep growing consistently. Bull market, bear market is for the entire market. There will always be a set of 25, 30, 40 companies, which will lead the bull market.
Amit, let's take that super cycle first, that first playbook that you're putting out there. And you're telling us that the internet stocks could potentially be in that super cycle, which means, you have the sector tailwind and you have growth as well, which could be sustainable in the near term. Now, I want to ask you about a couple of examples in the past, because the EMS theme, out there, we saw those stocks. I mean, the profitability went up by 5x, 6x in a matter of a few years. Or even when we look at the cash market, the volumes, F&O volumes, cash market volumes, when they went through the roof, that time you saw this entire, some of the exchanges did well, some of the wealth companies did well. So explain a couple of those super cycles in the past.
So typically what happens is, like right now, the global super cycle is internet, and where you have NVIDIA, AI, etc. NVIDIA is now $4.5 trillion market cap. That is as much as India's market cap. Typically what happens, like EMS, such a good example you gave. The largest EMS company in India. Stocks are not recommendations. Me, my family have vested interest, and we keep adjusting our portfolio, buying, selling stocks.
We'll get the disclaimer up on the screen.
But stocks like Dixon. Dixon used to make 120 crores in 2020. India was a net importer of electronics. Today, we're a net exporter of electronics. The profits of Dixon scaled from 120 crores to probably around 1,300 crores this year, and analysts are expecting around 2,000 crores next year. Option trading. It was happening in front of us. Big brokers like Zerodha went from probably 100, 200 crores PAT to now 5,000 crores PAT. Your BSE used to make 100 crores a quarter. Started making 100 crores a year in 2020. That's 25 crores a quarter. Now makes 530. And it was happening in front of us. You could see quarterly numbers. You could keep riding the trend. MCX as well, as an example that you gave. Option trading market, MCX started option trading in 2022. They got permission from SEBI, and from there, it's been a one-way journey. So you keep looking at changes. What is that large theme? And in that large theme, you keep finding names. If you want super performance, it may come by value stocks. There are hundreds of ways to make money, but we find our super performance comes from buying these super cycles and just holding. And capital market is a super cycle. It can keep changing names. We can change from, right now, the game may be AMCs as well. You have new two AMCs which are getting listed this month.
So if you have to identify a couple of super cycles, internet could be one theme, right?
Absolutely.
Internet could be one theme. Since we're talking about internet, as you said, NVIDIA's market capitalization is a few $1 trillion, right? And, if I look at a company like, say, Zomato over here, with all your disclosures, etc., some people say it's already 3 lakh crore market cap. But if it's got a tailwind, then do you think themes like these have a lot more to go? Because you add all of them together. Zomato, that's eternal, Swiggy, the other internet plays as well. Still, the market capitalization is not that much.
It's 8 lakh crores. So if example, Swiggy is at 1.08 lakh crores, Zomato is at 3 lakh crores, 3.2 lakh crores. You have Paytm at 70, 80,000 crores. You have Delivery at 30, 40,000 crores. You have First Cry at 20,000 crores. So basically, when you look up US market cap, $60 trillion is the total US SPX market cap. Out of that, semicon plus technology is about 60%. You're looking at 35, 36 lakh crores. If you take Tesla also being tech and all, then it keeps going higher. Tech is very hyper scaling, because in most companies, what will happen, Nigel, is your cost in tech do not grow with your revenues. So be it exchange. Your cost is not directly correlated to your revenue. So every incremental revenues is profit. So when your revenue goes up 100%, your PAT actually goes up 200-300%.
Correct.
And that kind of J curve will keep happening in India. Our total tech market cap right now in India is 8 lakh crores. Out of 500 lakh crores total market cap, we are at 1.6% tech market cap. When we end 2030, there'll be, of course, new IPOs that will come. But when we end 2030, and these private equity, there is no thing. Why did tech not become so big in India? Because these private equity guys would come and keep burning money and make sure the incumbent player doesn't make money. If incumbents' valuation go higher, what do these private equity guys go? They fund the second best guy and just keep putting money in and trying to see if they can make money. But that game is over. The loss-making game, burning game, beyond a point, it doesn't work. Capital is a shortage. Both competition to what the big name that you said, let's say competition to the leader of food delivery, Swiggy and Zepto. both have said that they will not open new stores. They will go towards profitability. And Zomato was the guy who didn't lose money. No recommendations, of course. We keep buying, selling stocks.
So from 1.6%, internet companies as a percentage of
it can become 20, 30, 40%. Every company will have to become an internet stock. There is no question that internet as a theme, as next, everyone will have to, every company has to move towards AI. So it's not possible that you will not. So a lot of value will get created.
So internet, that could be one theme that's in a super cycle.
But you still need great entrepreneurs. So a theme doesn't mean that you'll make money. You need to back the right entrepreneurs even after you've got the right thing.
Correct. And if I also look at, household money, equities in comparison to any asset, it's still very, very small, right? And the flows domestically are quite good. So do you think even some of these market-related players like an AMC, like maybe exchanges, they could still have a longer runway? Maybe they pause in a little bit, but on the whole, they're in a super cycle?
See, weekly options don't stop. I think capital market have already bottomed out.
Okay.
That, I don't know, CNBC keeps playing that it will stop, it will not stop. I don't know. But if this weekly option doesn't stop, then I think capital markets have already bottomed. This is my view on all your exchanges stocks. AMCs will do well regardless because they are not affected by the capital market, but other brokers, etc. The value chain has bottomed. The worst was priced in the day, where rumors were extreme high. That I think the worst probably may be behind, but it all depends on weekly options being there or not. If weekly options are there, then there is way more downside left in these stocks.
So two themes, internet themes and some of these market-related plays.
Capital market.
Capital market plays. Let's go to your next playbook then. So one playbook out of the way, super cycle is what you've told us about. Your next playbook is focusing on identifying the market leaders and also the emerging challengers. How should an investor approach this sort of distinction, in an industry?
So we divide India in 71 industries. In every industry, every quarter we track who's the guy who's gaining market share, who's the guy who's losing market share. From cigarettes, I'm just giving you an example. Cigarettes, this is happening very clearly. That the incumbent player is taking market share from the market leader. It happens in your two-wheeler vehicles. Two-wheeler vehicle is a 2 crore market. And right now, 2 crore two-wheelers get sold in India, and about 16, 17 lakhs is your EV two-wheelers. You need to see who will make it large in this EV market. So there are market shares that keep changing, and market values consistent gain in market share. If you see what TVS has done, TVS market share used to be single digit. It's moved to 32, 33% of the entire two-wheeler market. The stock has gone up 100x, whereas Hero Honda, which used to be at 45%, has gone to probably 31, 32%, and the stock has not done anything in 10 years. Basically, you keep focusing on in every market. This is like a playbook, right? You want a GDP growth is 10%. Nominal GDP growth right now is 10%. And now you need to find players who can grow at 25, 30%. Either they keep finding newer geographies, do acquisitions, etc., or they gain market shares. And market share gains is very persistent. So the stocks which keep gaining market share is very persistent. Every quarter they'll gain. This happened with, we don't own it, so I can say it, like Safari. First 40 quarters, Safari was gaining market share against
VIP.
Against VIP, where the world number one was Samsonite was losing market share. India's number one VIP was losing market share, and you had Suresh Jatia that was gaining market share very consistently. You keep track of every industry, shoes, right, beauty platforms, what is happening in which industry, which guy is doing well, and that is what we keep doing. And it is the best trend to have, is to have companies who are gaining market share. There is no risk in those. Typically, like there is a lot of outperformance you can find in those kind of names. See, the whole goal, Nigel, that we are doing this is to find outperformance.
Right.
What is the playbook for outperformance? First is super cycles. Second is market leaders or competition to market leaders.
Correct.
Competition to market leaders which can keep growing. Let's say
give us an example with regard to the cigarette theme that you spoke about. There is a smaller player who we all know is eating into some market share.
So we might have vested interest here also. We've got, and we can keep buying, selling based on quarterly numbers and a lot of things. But ITC is 20,000 crores PAT. And you have the second player who's at 1,100 crores PAT.
Correct.
45% of incremental market share is being taken by
Godfrey Phillips.
by the second player, 45%. And so there's a long way to go. So those are kind of themes. I'm not saying buy this stock, it's already rallied. But those are the kind of themes that you need to focus on.
Right.
That market share, like BSE was taking on market share of NSE.
Right.
In the option trading market, and 60-70% of BSE NSE revenues were option trading. So you need to keep an eye on a total industry size. Industry should grow at 10-15%, and your player in that industry should grow at 25-30%. And that is where you get super performance. Because Nifty will do right now, if your nominal GST growth is 10-11%, Nifty is not going to give us outlier returns.
Right.
If your 70% of Nifty stocks are growing single digit, how will you get outperformance? You will get outperformance only if you get super companies, but at right prices also.
Correct. Got it. All right. So we have identified that then super cycles, either the leaders or the guys who are taking share from the leader, making inroads. So we have got those examples as well out of the way. Let's talk about another, playbook that you look at, special situation plays. Could you tell us about identifying such opportunities? What are the key signals you're looking at out there? What is the trigger? What is that trigger point that tells you this is a special situation, need to get in?
So we look at everything, every news that comes, be it demergers, promoter buying stake, right issues. First, learn corporate actions very well. Biggest alpha creation is change in margin. That is the biggest alpha creation source. But second biggest alpha creation source is change in management. So we are fundamentally just using frameworks and processes to make decisions. We are only making 4 decisions in market: what to buy, when to buy, how much to buy, and when to sell. Coming to special situations, be it demergers from Adani. No vested interest, of course, but Adani also was a great story of demergers. Look at every demerger which is happening. Nuvama that we still might have no this thing, but Nuvama also we bought because of the demerger and this thing. We had in history, we've had stocks like Red Tape where we've done very well. So many demergers are happening and they all list tips. So many demergers, and you have to also look at acquisitions. We got in the top electronics player again, electronic EMS space again, only because it acquired Vivo's India's business. So basically, keep looking at acquisitions, especially if a company is acquiring companies 1x its size, 2x its size. That is where a large change can happen. See, we want asymmetry. Right. We want that if we lose 20-30%. But if things go right, you end up making 200, 300, 400%. And your entire portfolio cannot be asymmetry, but half of your portfolio can be asymmetry. Then you have market leaders.
Correct.
Then you have super cycles. You divide your portfolio in 2, 3, 5, 7 themes. And that is how you build a great portfolio.
Got it. All right. Just a quick question, since you're talking about this inorganic growth as well. Off late, we have seen RateGain. They went and they bit large. We had Tega. They went ahead and they did a larger size acquisition as well, or even a Tilaknagar Industries. Those as well could qualify as a special situation?
We might have vested interest in some of them, but you have to look in them. Tilaknagar has bought one of the largest Imperial as is this thing. We don't have any positions, no recommendations, but you keep tracker of them. Like this is a point where the J-curve can start at any point of time.
Yeah.
From a brandy only player, the valuations are cheap. And typically if you look at what valuations your Radico is trading at, it trades at 100x.
Yeah.
So you know alcohol as a space, even United Spirits, which doesn't grow at all, gets 60-70p. So you know in your mind a national player, whiskey player, gets what kind of valuation. And then if they get the execution right, which is not so easy, if they get the execution right, you can just hit sixers. Now it becomes your tracking position.
Correct.
First you track, right? You don't just, the day announcement happens, you may buy if it's a full toss, or you may wait. But in Tilaknagar case, we are not.
You're not invested?
Not yet, but we are looking into it. The other names we might be invested.
Okay.
So, but we also have tracking quantity. So it's not like when we go, we buy only straight 3% of our portfolio.
Short point is identify that special situation and see whether or not it fits into your scheme of things.
Change in management is the biggest alpha creation driver. Be it CG Power.
Yeah.
Bigger than demerger, the criteria that works. So I'm just telling you back-tested numbers of everything. Change in management. If a large company, if a small company is being bought by a large corporate, that theme is the best theme ever. Even your...
Got it. So Amit, I'm just going to, I'll tell you what. You have told us about super cycles, identifying the leader, also playing those special situations. But we'll take a short break, come back. We'll focus more on risk management. And how do you know when is the right time to get off? the bus. Slip into that break, come back. We've got lots more lined up. Welcome back. You're tuned in to Finding Alpha. It's a Diwali special, and we have Amit Jeswani, who's with us in the studio. Amit, before we talk about stocks and equities, I want to ask you your view on gold. How do you see the current rally shaping up? Do you think we're at the later end of the rally? I mean, your quick view on gold?
My wife is very happy. My mother's even happier with this
and
rally.
You've got a little girl, so you need to buy some more gold.
But this is a trend. This is a super trend right now. It's a de-dollarization trend. I don't know where this will end. But right now, the trend is there. Any dip looks like a buying opportunity for now. And silver's just broken out the 40-year level. Now, how can you stop a breakout after 40 years? We've not seen this kind of breakout in many, many, many years.
Yes.
So I don't know. This will eventually become a bubble. And people say that, you know what, I told you not to buy at this level. But it may happen at $6,000, $8,000. Silver can go to $100 and then the bubble can blast. So the whole part is that I have a saying. Be greedy when others are greedy. Be fearful when others are fearful. You make the most money by riding a bubble, not by being out of it, as long as you can sell it at right points. But in the stock market portfolio, we are playing gold via a gold finance company and the exchange, the commodity exchange. Which should do decent, hopefully.
So, a larger gold finance company?
The largest gold. See, we don't buy the 10th best company. In any sector, we want the best company because that's how you can manage your risk. They fall the least and they need to grow also the fastest. The gold finance, the largest gold finance company is growing at 40%. And the smaller ones are growing at 15%. Why should I buy the small ones?
No, I was asking you because you spoke about management change as well. So I want to know whether you're going for the one that is...
We had the management change, which one you're referring to.
Right, Manappuram, so it's not Manappuram.
But we don't have it in my portfolio. We sold out because we thought that jo chal raha hai, uske saath hi zyada
Muthoot is the leader. So we get that on board. You're going with the leader out there. And in terms of commodity exchange, it'll be MCX. But, before we wind down, you often talk about, everyone talks about riding the winners. But don't marry the stocks. That is important as well. When do you decide it's time to jump off?
So I had this old saying, I'll say it again, stocks are girlfriends, stock market is wife. You don't get out of the stock market ever, and you have to stay invested whatever it happens. But every cycle is different, every 2-3 years. And people who buy and hold is not working. See, our goal is to make money. That's our only goal. Buy and hold, every 2-3 years there'll be new winners. And you have to see where the new incremental growth is coming. If a company is growing at 30%, and market thinks that the company will keep growing for 5 years for 30%, markets in first 1 year or 1.5 years will discount the entire 5-year growth. And after that, if you have that stock, you're not going to make any money. It will just, only the results will make you happy. The stock prices will not go up. Markets are hyper discounting. You have to keep finding newer cycles. Every cycle is different. Don't have 10-year horizons. Have 2-3 year horizons. Max 2-3 year. And you have, think about it. If I have 25 companies in my portfolio, you always have 25 companies which are looking good to you, right? And you have to keep adjusting your portfolio. Where is the next incremental growth? Where is the next discovery? See, if you want outperformance, if you want beta returns, that's different. But if you want to be the best, then you have to keep finding newer cycles, and there will be newer cycles. Tell me 1 3-year period, and the next 3-year period, the same stocks go up. It doesn't work that way. Now, markets are very different. 18 to 24 months are the size of one cycle. You keep finding those cycles and keep playing in cycles.
Very quickly, GLP-1 is a big opportunity.
GLP-1 is a large opportunity, and you need to buy, it's a super cycle. It's again a super cycle. I'm not fit, but hopefully I will get fit the next time I come to CNBC. Without GLP-1s, but it's a large trend. There are already 1 lakh users in GLP-1. It's a large opportunity, and you need to find a pick and shovel method. When gold rush was there, it was the jeans guys that made the money. So you need to find, according to you, who are the pen guys, who are the other guys, and I hope to make money. I don't know. You can lose money also.
No, and GLP-1, I mean, one of the disclosed investments that all made a small investment is Stallion Engineering of late.
Very small part of our portfolio.
Very small part.
But risk management, you have to cut your losers. Nigel, if we cut our losers, and even if I like a story, But if the stock is not doing what we thought initially it would do, my team is beyond me. So whatever happens, have that discipline. If you are finding super performance, be ready to make mistakes. In markets, you will keep making mistakes, and mistakes are part of the game. Do not marry your stocks.
Well said, Amit. Well, we thank you for coming down to the studio for this Diwali special. Thank you for taking us through your investment playbook as well and warning us with regard to the risk. It's a pleasure having you on the show. Well, hope you guys had as much fun as me on the show. That's Samvat for you, telling you about identifying cycles, riding the themes, and also booking your losses when the time comes. Well, we'll wrap up on this edition of Finding Alpha, our Diwali special.